Okay, guys. Let me add people in the meeting. Okay, the computer. Okay, guys. Hi everyone. My name is Russell. Russell Follas. Again for a new live webinar about another important topic on how to pay less taxes. Right. And today's topic is basically tax planning. A lot of people talk about tax planning, but most of the time you really don't know what tax planning is. So today's topic is tax planning. Right? Today's topic is tax planning. So what is tax planning, and actually how does that help a business owner or a self-employed or even a single taxpayer? This is what we are going to discuss today, right? Yeah, we are going to discuss tax planning. We are going to see some type of example of tax planning, or the main focus on the tax planning for businesses and for individuals as well. And we are going to show a case study of one angle of the tax planning, how it can actually help a business owner or an individual to save taxes. Okay, so basically, yeah, I'm going to explain what the tax planning is and give you the main area where CPAs and tax professionals focus on helping business owners. Yeah, whenever you get in, just mute yourself. Just mute yourself when you get in. Okay. So it's really important. It's really important. Everything I've been doing since then. Let me just try to mute other people. Okay, yeah, I see other people there talking. Let me see if I'm not mute myself. I think I'm mute. I was mute myself. Okay. I hope everybody was hearing what I was saying. We are on the Facebook Live. In the meantime, we are on the weekly Zoom meeting with the Facebook group that I have created to help small business owners to get funding. Remember the EIDL and the PPP loan that was available for business owners. Yeah, we actually created a group to help all these business owners who were struggling to find financing to survive during the COVID-19. So basically, as a bonus, I said when I created the group that like a weekly, and I will actually provide them with some type of tip on how to actually even save the money that they are actually making in their business by actually using tax strategy and tax planning. So that's the reason why every week within the group we have this type of meeting or webinar. And sometimes I feel like I can also help other people. That's the reason why we have put this on live. But of course, this is only going to be for the first part. The second part is going to specifically be for the people within the group, within the Facebook group, because I have specific information to share with them, especially concerning the loan, right? If somebody has a question, he may ask. Yeah, sorry guys, I don't know what happened with the Facebook broadcasting. So I think I was at the point where I was trying to explain what the tax planning is, right? So anytime you as a business owner or as an individual, right, within the course of your business or within your life, you are taking action with the intention on mind to save on taxes, right? But also knowing what tax law, what disposition of the IRS will help you to take that taxes. And most importantly, action taken during the year. During the year, not on April 15. That's the difference, right? Not on April 15. So that is what tax planning is. I don't want to give you a non-definition, non-tax definition or account definition about what tax planning is, right? So, what do we even talk about tax planning in the first place, right? Why? Why do we even talk about that? We talk about tax planning because we live in an ever-changing landscape, right? The laws are amended. The tax law is actually amended like every year, basically. That's the reason why we will have new IRS publication before we actually start doing the taxing, because there's always update. Sometimes there's amendment, and we know that 2017 there were a complete new set of tax law, right? So that's the reason why the landscape, whether it's an economic landscape with the COVID-19 here or the political landscape in anywhere in the world. By the way, what I'm saying here could be applied anywhere in any country, because there are many people actually watching this that are not even in the US. But the typical case study that I will be showing is for the US tax law, right? But in general, like I said, what I just said about tax law, to take action, to initiate, to structure, okay, I'm not going to go into the detail yet. Any action that you take, that you think, okay, I'm going to do this so that I can pay less taxes at the end of the year. And you know what disposition of the law will help you pay that tax or save on that tax. Anywhere in the world you find yourself, you can do that, right? Now, the problem with the tax law, the reason why you have to talk about tax planning is because the political or economical landscape in most countries, right, changes. Is not always stable. Sometimes, it will never be stable, right? So not only that, but we say the tax law is amended. Company growth and net income changes, which has an implication, right? When your net income changes, your company grows, it means that your taxes will also increase. In order to not pay more taxes because of the growth of your company, you actually have to do something, right? Of course, as that result, your business liability will increase, right? You will have to hire more people. An employee is a liability. When you have an employee, that's a liability. You have to get more loan, right? Because you want to expand. All of those can have an tax implication at the end of the year. So that's the reason why tax planning, we even talk about tax planning, right? And if you do nothing as an individual, for example, what will happen? Or even within the company, if you do nothing as a company, let's say as an individual, you may lose something like your house, right? If you owe the IRS and you don't know how to negotiate, because you didn't know what to plan to help you owe less money on your house. The more money you owe on your house, it could happen that the government even takes over your house, right? You know that. Your business could actually run out of cash flow if you don't plan. If you don't plan, your business may actually run out of cash flow because you'll be paying more taxes than you would have used within your business to actually the operation of the expansion of your business, right? You might even lose your personal asset. I say your house, but it could be anything. It could be your car or your bank account. If you don't plan tax-wise, everything happen in your life. Whether you are married or separate or divorced, it could have a tax implication in your life. So you always have to consult anything that happened during your life. So you have to consult, or if you plan that something will happen in your life, you always have to consult. Otherwise, the consequences are always greater than what you think you save by doing nothing. That is on the individual side. On the business side, if you're planning to open a new shop, to acquire a new business or to even sell your business, if you don't consult, because it doesn't just come all of a sudden that, okay, I'm going to sell my house or I'm going to sell my business. No, it's a process. You plan, maybe because you see a lot of losses, you have been accumulating a lot of losses, you think your business is no longer profitable, you will have to consult a tax professional for that, right? So the solution is what? A business must continually review its overall tax position. You always have to review your overall tax position, because we just said that tax law changes. It even can make the tax law being amended even during the year. We saw with the COVID-19, a lot of tax law are amended, are updated, right? A lot of them. But if you have made a plan to do something and you stick on that, you are losing money just like that. And you will lose money. How do we know you lose money? When somebody who can actually show you what you have lost as a money, because you didn't adjust with the changing on the political, economical landscape, right? So individual must always review its expenses and income forecasting and takes proactive action, right? Individual must always, review. And I think we already went through so many webinars where I was explaining how it's important to actually trace your expenses. Even at the individual level, you should always trace your expenses to know exactly what are your expenses. If you know what are your expenses for the month or 2 months, you will take action, because you will discover a lot of expenses that are not really needed, that were not needed, that you could do everything that without making them, right? And or you could have known how to make them, because one of the main area of the tax planning is a structure, and we are going to get into that in a minute if you stick on the webinar, right? When you trace your expenses, if it's possible, if it does with at the individual side, what about the business level? So any business can always or has always have to follow and trace daily with daily expense, because tax planning is most likely about expenses, because the way you structure your expense can give you a tax credit. Basically, that's what I mean. So this is tax planning. So all of that is to actually planning your taxes or planning your activity according to how much you want to save on taxes, right? So to reduce your taxes, basically what you have to do is to plan, right? If you want to do something, want to pay less taxes, you have to plan. So what is the difference? And no matter what your CPA or your tax professional or your accountant within your company, you have a company, and you have so many accountants, you have even a tax department in your company. No matter those people are, right? You will never, April 15 is not the time to actually do the tax planning. April 15 is not the time to actually take advantage of what was available to you during the year. April 15 is the time to prepare your taxes, basically. April 15 is not the time to actually, when I say April, I mean the January to April 15, that period is the time to file your taxes. It's not the time to think about, I need to take this, because your tax preparer will tell you, okay, this is an opportunity to you. And you say, yes, why can we take it? And he will tell you that you just cannot take it, because it's something that you have implemented 12 months ago, right? And that you will see the result now. That takes us to talk about the difference between tax preparation and tax planning, right? What's the difference between tax preparation and tax planning? You have to know that tax preparation is a reactive tax strategy, right? It's just a reactive tax strategy. They also call it after the fact tax strategy, because during that time you sit at your CPA to say, oh, I need to take a lot of deduction, I need to take this, I need to pay less taxes, I need to get more refund, or I don't want my company to pay too much money. You tell them. They are just reacting to what happened already. And they also call that after the fact. I think I said that already. It's called after the fact tax deduction. So it's a reactive tax strategy. If it's an after the fact tax strategy, so it has limitation. So what it is in fact? In fact, it's what? During the tax preparation, your accountant or your CPA or your tax professional just record. What he does is what? He records all the transactions in accordance to the tax law. So he goes through everything that you have done during the tax law and sees what is available that he can take. He doesn't make up anything. There's nothing that he can do at that time. Yes, there are some things that are obvious that you may take, right? Your standard deduction, maybe you have children, you get credit for that. Maybe you actually you purchase a car, you take credit for that, you take deduction for that. Yeah, those obvious deduction, he's going to take it, or he's going to take them. Those obvious credit, he's going to take them, right? But I'm pretty sure, or most of the time, 50% of this tax strategy that are available to you are not taken during the tax preparation, right? And some CPA will not even let you know. But I always tell my people, this is what you have lost by not implementing this strategy during the year, right? Sometimes when you say that, they will ask you why. Why can't you take it now? Why can't you do something now? I say, I'm sorry, I cannot do that. Some other people will have to make up something to make that happen. You go within the law. If you go within the law, I will actually advise you on what to do so that next year, what you have lost this year, you will be able to take next year. This is actually how I always see the thing. So basically, the tax preparation is an reactive tax strategy, right? Where your tax professional, your CPA will just see what's available for you. And as a contrast to the tax planning, which is an proactive tax strategy, which is also what is called before the fact tax strategy, right? What's the difference? The difference between reactive and proactive is that in the proactive strategy, we are anticipating. We are actually anticipating on what will happen if we do this today. Let me add this new member in the group. Okay, there are two of them. Okay, good. So yes, on the tax planning level, as opposed to tax preparation, the tax planning, your CPA or your tax professional, what he will be do? He will be the tax professional will actually review all your financial position, right? Your CPA will review all your income statement, all your financial statement. He will review all your income. He will review all your expenses. He will review on the individual side a possible event that will happen in your life. That's what he will do. He will review all of that, right? And he will actually customize a tax plan according to your own situation. On the tax preparation, what you can take is flat. If you don't take it, you don't take it. It's most of the time, I have to mute whoever just got in. Okay. Yeah. So yeah, like we said, the tax professional will actually just review everything that is finance, that is investment, that is future expenses, that is future income. That is on the business side. On the MGS side, same thing. They will see what are the potential life events that will happen to you. Are you going to move? Are you thinking about buying a house? Are you thinking about getting divorced? Are you thinking about doing this? All of those, that's a tax preparation. Anytime, if you even feel like there will be a life event in your personal life, you have to consult with the CPA, because so many people will be surprised with the outcome, right? Or even at the end of the year, even though you want to sell your house, you have to consult with the tax professional to see what will be what are the outcome if I sell my house like this, or if I don't do this. Yeah, so during that time, your CPA actually just go through everything that happened within your personal life or your business life and see what are the opportunities that he can do within the law to actually help you saving money at the end of the year. That is the proactive strategy of the tax saving, as opposed to just wait January 1st to April 15th to actually scrambling to find a new write-off for businesses, deduction, to find credit as an individual level. To start telling them, oh, I think I did this, I have done that, I fixed my house, I wanted to take this. Yes, so that is tax planning basically, as opposed to tax preparation. Now, how long does the tax planning last? That's a good question. How long does it last? At the beginning, I was saying that the tax planning is, I was letting you know that the tax planning is an ongoing process, right? It's an ongoing process. That means you have to consult your tax planning at least twice a year, or maybe 3 times a year. At the beginning of the year, on the middle of the year, and at the end of the year. At the beginning, to actually see, like, to lay down everything, all your individual financial position or all your business activity, so that we will plan accordingly. Because at the beginning of the year, the tax professional can see from your financial document all the past activity, and he can forecast, and he can ask you, what do you think? Do you think it's going to be the same, or do you think it's going to increase? Depending on what you think. Maybe you want to spend more money in your business, right? You want to spend more money on your business. That means you are anticipating that there will be a 20% increase. That means the gross sales, we're going to add 20% to it when you apply the tax strategy that will be available to you. So that is basically what you will do. So since it's an ongoing process, that's the reason why, because life situation changes, right? Tax law changes, tax credit comes and go. I think we see that already, and that's the reason why you always need to consult at the beginning, or worst case scenario, at least during the year, at least once, because some strategy could be created or implemented as if it was implemented at the beginning of the year, even though we are within December, right? So you always have to consult before you think about going to file your taxes. When you're going to file your taxes, most of the time, there's not that much that you can do, right? So yeah, that is why, and the tax planning is like, it's basically in the company, it's like an internal audit, basically. I'm talking here about the cost. Imagine that within your company, you want to conduct an internal audit. The internal audit, as opposed to the tax planning process, is that the internal audit actually scrapes all your financial information and to see if it complies with the SEC, right? Or with the GAAP if you are in the US. That's what they do. So they will check everything, if everything is done correctly. But they do that with in mind if you have done something wrong. As opposed to the tax strategy. The tax strategy is actually doing the same thing. The same thing, just that they do that with the IRS in mind, like with the intention of finding the opportunity for you to pay less taxes at the end of the year. That is actually what the tax planning is, and that's the reason why. Many times it will cost a lot, and that's also the reason why many business owners or every self-employed people or even single individual taxpayer will not go to a taxpayer because it costs a lot. It costs maybe 10 times just filing your taxes. That's how you can see that it's more important. If you want to file your taxes, if you pay 5,000, if you pay 500 to file your taxes, you may find yourself paying even up to 5,000 or 4,000 to get a good and efficient tax planning, right? You can see the difference. What is more efficient? What will help you a lot? What will help you more? Between the 500 over here and 5,000 here, do you really think the person you pay 500 to file your taxes is doing the better job, or you will get the better outcome than if you are invested 5,000? No. This is an investment. Your tax preparation is not an investment. Your tax preparation is like you are trying to be compliant with the law, right? You're trying to be compliant with the law, even though you're gonna owe the government, even though you're not receiving no refund, you still have to spend this money right here. I'm still bringing it down, the difference between tax preparation and tax planning. Over here, when you spend $500 or $600 or $1,000, I'm just putting a number like this. You spend $500 to prepare your personal taxes, or you spend $1,000 to file for your businesses. You are just paying more money than this because it's more complicated to actually filing it, because there are so many moving parts that we have to get together to actually prepare your taxes. Not because they are saving you in taxes. I just want you to know, not because they are saving you more in taxes. So unless they are, or he's able to implement a tax strategy, I'm not going to go into all the tax strategy here. Some tax strategy that could be implemented just as if you have implemented them during the year. There are some, very few, unless the person does that in your taxes. If he doesn't, he's actually trying to see what is available. He's doing his maximum to see what is available to you. But there is a way that he cannot go beyond what you didn't anticipate it. There's no way he can take it for you. So if you're spending 1,000 in your business to file your taxes, you have to know that you should be spending 10,000 or maybe 5,000 or 6,000 and see how much you'll be saving in taxes, right? There's always opportunity of saving in taxes. That is what I want you guys to know. Whether you are an individual, just a individual taxpayer, or you are a business, there's always, until you conduct a tax planning examination or consulting to review to you what is actually available to you, okay? Until you do that, you will never know what's available to you. I'm not talking about what your friends, your sister, your mom told you. I'm talking about consulting, or if you don't want to consult with a tax professional, go through the IRS. The IRS has a website, right? Check for your business. Check for all the credit tax deduction that are available. Now think about how you can structure I'm talking about. This is the main type of tax planning already. Found out how to structure your business the way that you are able to actually take the credit that is available for you. The first thing to do is even know what credit is available for you. Very few, if I don't know how many business owners are watching now. If I ask you, what are tax credit or tax deduction available to your area of business? If you are, I don't know, real estate, you are a carpenter, you are, I don't know, a lawyer. If you are just you own a barbershop or restaurant or a wedding salon, whether it doesn't matter what activity you are, what are the tax credits that are available to you? It doesn't matter whether you are able to take it or not. You have to take it. If you don't consult, spend time. In the life, you have to choose. If you have more time than money, spend your time to do the research. If you have more money than time, spend money, because at the end you are winning. Whether you are spending your time or you are spending the money, you get something. You are winning. You are gaining something. That's the advice I always give to my people. I will explain to you, and I can also give you link to the hours to actually take more time to check into and see what are available to you. And that's the tax planning, right? So there are three main components of the tax planning here, right? To save money, there are three main things that we do, that CPA do, that tax professionals do, that someone who can actually do it, that's himself, can do if he knows how to use them, right? There are three of them. The first thing is structuring. I've seen that already. I'm going to just put it on the board. Structuring. The first one is structuring. What does structuring mean? Structuring means that a tax planning can help you restructure a lot of stuff, a lot of situations. It could be that they are restructuring what? Your business entity. You could be restructuring your business entity, right? You could be restructuring your business entity to make it favorable for you tax-wise. You could be restructuring your expenses to make it more, to make a deduction basically. You could be restructuring an expense. The way you structure an expense can give you a credit that someone else are not able to take. Just because the person did structure that expense according to something which is saving in taxes, right? For example, when you are purchasing a car, you can take like a deduction because of the car or the type of the car that you purchase. If you know that you are going to gain $2,000 as a tax credit, you will structure this that purchasing of the car the way that you get this 2,000 credit. That's basically what it means. So structuring is basically the main thing, the first thing that people will do to save in taxes. I'm just sharing it just like this with everybody, right? An expense. I saw a video where someone was charged by the IRS $1 million. Like the IRS remove $1 million deduction in his taxes, in his income statement, because they said the expenses that she made was not a business expense. They saw it as a personal expense. in a business, you cannot combine personal expense and the business expense. Then they will remove it, and your net income will increase. Your tax bill will increase as well. So a tax professional was able to actually structure this 1 million expense the way that it became a business expense. It was actually a 1 million. It was actually a yacht. So that person purchased a yacht. It was a real estate professional development. So they purchased a yacht, yacht like a boat, to go out on the sea and have fun and stuff. And she put it in a business as an expense, right? So what happened is that they removed it. But a good tax professional was able to actually structure and let the IRS know the reason why this could be a business expense. That's structuring. Just the way that you structure something can give you an advantage that you will not receive if you don't do it. The other structuring is the retirement plan. You structure the structure of your retirement plan. As a business owner or as an individual, you have to know the structure of your retirement plan and know which one is more tax-wise favorable to you. That's what you have to know. And there are so many types of retirement account. You have what is called traditional or Roth IRA. You have a self-employment 401k. You have the simple IRA. You have the SEP IRA. You have so many different types of plan, right? Retirement plan. Each retirement plan will have an advantage that is greater than the other one. You have to structure. Just by structuring them, will give you a more evidence in having or applying or implementing a good tax planning and save you in taxes. That is basically what it means. The other main factor here is deduction. In your tax planning, you are taking deduction. Deduction you are taking sometimes are not as an expense here. I have to put income as well. You can structure your income, but you can anticipate an income as you can push back an income. Tax wise, you have to know all of that, right? Same thing for the expenses. You can anticipate an expense as well as you can push back an expense because you want to take advantage of the taxes, right? On the deduction side, there are so many deductions that you need to know and plan in advance in order to take them. There are so many deductions. For each business, there are deductions. And the deduction, if you don't plan, you don't even find it. And at the end of the year, this is not the time during the tax filing, that your CPA will actually find the deduction that you have implemented. Find what you have done during the year to take a deduction. He will make sure that he can take the deduction that is, or deductions that are available now for you. But the deduction that you have made during the year, right? I need to mute some people. So I said last week that one of the strategies on saving in taxes was what? If somebody can remember last week, it was about putting family to work. That's a tax strategy because you see that you are going to have a lot of gross net profit, and how to do that, you don't actually pay taxes on that. You put family to work, you put your son to work. If you anticipate that you put your son to work and you spend 30,000, that 30,000 will be deductible on your son. And he doesn't even have tax and payroll tax on it. Right? Because some people will say, okay, oh, I don't want to hire my son because I don't want to hire this my wife because I'm going to pay payroll on it. If somebody watches the last week video, he will see the advantages of hiring the family, right? So as you are hiring your son, you don't pay payroll tax on it. I spent last week what payroll tax. That's a strategy to be able to take a deduction. You're not going to work at the end of the year and say, okay, oh, please, can you claim that I pay my son $40,000? It's just not possible. That's a deduction. Or more than that, the structure here also comes to the to how to structure the choice of your compensation, owner compensation. At the end of the year, I say, oh, that type of remuneration of your partners are not helping you. It would have been better if you have used this type of compensation of the partner of the LLC, of the members, right? And you'll be like, okay, why can you just consider that? No, you just cannot consider that. It has to be something that you have planned, that your CPA will see all the financial situation and say, okay, you know what? One of the advice that we give you guys is that if you change your compensation structure, this is what you will be able to get tax-wise. This is how you'll be able to save at your company level and at your individual level. We still see stuff. I just say what? This is the remuneration, compensation. And you will see what Amazon did. I have an example here to show you how what Amazon did, right? So those are deduction. The third one, right? That one is what? Is credit. Is credit. If you know what you can get as a credit, you will conduct your business the way that you can take that credit. Basically, at the business side, at the business level, as well as on the personal level. If you, it even depends on your area of activity, whether you're a teacher or a nurse or a lawyer or an accountant, what are credits available to you? Or your business is involved in the environment, what are credits available to you? What are the criteria to be able to take those credits? Those are what you need to consult a tax professional for. Any business activity, any individual is always available, is always able to take some type of credit. It doesn't matter what credit is. And those credits are mostly linked to your activity, to your business activity or your just daily living. Those credits are linked. For example, I just say here that you are fixing your house. You fix your house. You fix your house because the house has a problem. But if you know what credit you might get, if you use any different type of material to fix your house, you will try to use that material to fix your house. And not only you will deduct the cost of fixing your house, but you will also get a credit for the same activity. That means you purchase a house, you deduct the cost of repair, and you got a credit. Two different things. Same thing for the car. We have some type, what is called some type of environment-friendly credit for people purchasing the car. If you purchase a car and you have in mind, okay, you are concerned, okay, the company is purchasing a brand new car, or myself, I need to buy a brand new car. I'm done with those used car and stuff. I need a brand new car. I have money for that. Or whether it's a cash or finance, I have money for that. So if you know what could be available for you to get a car, you will actually shape your choice the way that you could actually take that credit. So that's his plan. I mean, failing to plan is planning to fail. That's what people say, right? If you fail to plan, there's no way you can take the credit that you have taken if you have planned. That is basically what it means. So those are the main pillars. Those are the main pillars that you have to the tax professional area. Those are the main one, right? I mean, there are more, but those are the main one that we focus on, right? To get tax saving at the end of the year. And all of those are implemented during the year. Most of them, maybe one or two, maybe done even after the year passed, right? But you still have to consult with your tax professional for that. And you will still have to pay him to implement that. And there will be some limitation, even though you have to take them, because at the end of the year, there's so limitation on what you can take, in what you can take in terms of tax planning, compared to if you have implemented them at the beginning of the year, because you have more homes, right? So those are the main ones. I'm going to talk about Amazon. Amazon, on the 11.2 billion profit, Amazon made 11.2 billion profit. 11.2 billion profit. I think maybe it was more than that. On that, they paid $0 on income tax. $0 on income tax for 2019. 11 billion profit. How much profit did you make last year if you're a business owner? Can you tell me how much income tax you pay? Right? How much did you save? I can say that he saved everything that he was supposed to pay. Why? Because it is the plan. A some plan are even done for years. That means you implement a plan today because you know it will give you results in the next 2, 3, 4, even 5 years. Yes, that's planning. And that's what Amazon exactly did. That's what it did. And an example of what he was able to take, he took it was more than 100 million on what is called net operating loss. So Amazon was incurring losses in the past because he has a plan that when you are incurring loss, it's because most of the time it's not that the company is not good, but you are not focusing on making profit now. The company is actually selling, but maybe you are also investing even more than what you are making, right? It could make you be in the loss, but you know when it reaches the peak, you will get like a crazy result, right? So Amazon took 100 million on what is called net operating loss. Net operating loss just means that it has a net loss during the year for a couple of years, right? Amazon took 419 million for what is called R&D credit. R&D credit, research and development credit. Amazon took 419 million on research and development credit. Why? Because they knew or the team of CPA and big accounting firm knew that Amazon is doing the tech industry. And the tech industry, this is what they have. So they focus not to make profit today, to make more profit next year, but they focus on research and development. That's why they have developed everything that you guys see out there. Amazon is on everything, right? They manufacture everything. People think Amazon is just a marketplace where people come and sell, but Amazon does 10 times more than you think Amazon is doing to make money. That's the reason why they're #1 now, right? So Amazon did what is called 1 billion on deduction for stock-based compensation. Stock-based compensation. 1 billion, the B, a big B right here. Amazon took 1.B stock-based compensation. What does that mean? It basically means that he makes money, but instead of paying people, he just gives them the share of the company to his employees, right? He just uses stocks to pay his employees, but he's taking 1 billion expense, even though he didn't spend a dime. Can you imagine that? Instead of giving money to them, He's giving them he's giving them a piece of the company. Let's call it that. But the issue, his goal now is to actually pay $0 or pay the least amount in taxes. That was his goal. That's the reason why he did that. And you know, he can also buy back those shares. He give it to them. Next year, he can also buy them back, right? If he really want those shares, he can pay back and buy those shares back, right? So those are basically the area of expertise, or the area where people can actually save in taxes. Okay, I'll just show you. Those are the three main structure, the three main area where CPAs and accounting will focus to help you implement a good tax planning. Okay, on the structure here, on the entity structure, I say structuring. You can structure your entity structure. I'm going to give an example here. I'll give an example of expense structure, where somebody can actually structure the expense at a personal expense that becomes a business expense. I just say that here. Now you can structure an entity of your business the way that is more favorable to you tax-wise. And I'm going to share with you a case study where you can actually see how just by converting your LLC structure to C Corp structure, just for taxes, can help you save more money than you can even imagine. Right? Yes, we're going to do that case study. But as I'm just cleaning the board, if someone has a question, they can ask. If someone has a question, you can ask before we proceed. Does anyone have a question?
Yeah, who said?
Yes.
You said
who is talking? Sorry.
Amazon made a profit of 11.2 billion.
Yeah.
Billion, not million, right?
Yeah, billion, yeah.
Yes. Do you have any, it's just mind-boggling that they made 11.2 billion and it's not pay a penny taxes. But the number you just gave, you said they put 1.1 billion in in the stock market, whatever to.
Yeah, they call it StopBased Compensation. Yeah, they just pay, instead of giving money, they give the stock.
And $400 million is something, and another 100 million. I mean, that adds up to just barely, not even 2 billion. Do you have any idea how did they just, that leave about 9 billion in profit? How do they write that off? Do you have any breakdown on those numbers where how they were able to still not pay any taxes on the 9.something billion left?
Okay, those are just a few deductions that I just put on the board. There are so many other credits. That the credits is what? Is that normally on let's say on this morning on the 11 billion, let's say your taxes here will be, imagine when they say you save in taxes, it means that on that billion, 11 billion, you should have paid, I don't know, maybe 2 billion as taxes. That's what it means. You should have paid 2 billion for taxes for this level of income. But you came up with credit. The credits actually deduct directly, dollar for dollar, your tax bill. When you come up with a credit, it deducts this amount dollar for dollar. That means if you have a credit for 2 billion, then your tax becomes 0. If you have what is called net operating losses, I just said that they took hundreds of millions of net operating loss. Net operating loss means that you have 2 billion of profit. If I have 9 million of net operating loss, I'm going to deduct this here out of this these taxes before I see what I have to pay. Do you see that? Francis?
Yes.
You see that? That means the net operating loss is that this year you are accumulating a credit, a loss. That's not a problem. Next year, so on. But you know when you're going to take it because your strategy will put you as $1 trillion of gross in 2019. That's a projection. And I have a team of, I don't know how many dozen of CPA working on that. So they know they're not surprising. They know that they will hit this year. This is what they will take. Of course, they will adjust accordingly every day, every year. When the economic landscape changes, the law changes, they modify accordingly until they hit this. That's the goal. And I'm pretty sure next year, I'm not sure they're going to take to pay $0 because unless they are also implement other strategy just to pay less taxes next year. So the point is that I cannot, if you want, go online. Those financial statements are actually available online. When you are a public company, all your financial statements are public. You are a public company. I mean, you can see all the deduction. If somebody wants to see, go to the FCC, try to pull out the financial statement for Amazon or Apple or whatever company you see. You will see what they are taking. Amazon is not the only company. I think I run a live where I was showing at least 7 companies. 7 among the big, those billion-dollar companies who pay $0 in tax. Amazon is very because they are the bigger company now in the world. That's what they're talking about them. So there are many of big companies. I think this company, Verizon, I don't know what company it was, also pays $0 in taxes. There's this big airline company, I forget the name, also pays $0 in taxes. It doesn't just come like all of a sudden. It's a strategy. If we're talking about Amazon, $1 trillion company. What about you? Maybe you're making, let's say $900 a year. That's not even your profit. That's your gross sales. Or you're making $1 million in sales. Don't you think that you are more favorable to take a credit than somebody making $1 trillion as gross sales? Yes, you are. You just need to invest. Because at the end of this million, you will define yourself. The average company, by the way, I'm going to show here what is the C Corp tax rate. The corporate tax is 21%. That means 21% of this is what? It's just $210,000. You are paying $200,000 as taxes. That's what it means. Over here, you make $1 million. You pay $200,000 tax dollars. This is your profit, okay? If this is your profit, you are paying $200,000. Somebody is making $2 billion profit, but he's paying $0. Who is paying more taxes? Of course, you. And if you are asked to invest even $20,000, it will be worth it to invest $20,000 and know that you can save this amount and maybe pay only a quarter of that. Yes, it will be a good investment. This is what, and this is on the business side. On the individual side, it's the same thing. I showed you sometime here last time that if you are an individual, taxpayer individual, you are making more than $70,000 a year. More than $70,000 a year. And you don't have no tax planning. I just say what tax planning is to actually initiate an action with the tax saving in mind and do that during the year. If you have not done that, you are overpaying taxes, no question asked. Why? Because the bigger expense most of the time is the rent. $1,500. If I'm so generous, for 12 months, this is $18,000. If you're making $70,000 here, if you're making $70,000 and then you pay $18,000 and we know that the rent is most of the time is the bigger expense in the household, right? The rent or the mortgage is the bigger expense in the household. But that bigger expense is not even what? What's the difference over there? That is $50,000. What did you do on this $50,000 to pay less taxes? You're going to say, oh, I pay grocery. It doesn't count. You're not a business. Whether you fix your car, you do this, it doesn't count. You cannot take a deduction on this. Basically, there are so many things that you have done in here just by structuring your normal expense, whether it's buying your house, pay for your school, saving for your retirement, or whatever you do, that's people making extra money do, right? Some people will just put this money in the saving. Let's say he spent $20,000 for food. You will just put $30,000 in the saving account, right? What about you consult with somebody? You are paying taxes on this $30,000. You say it's a saving because this is okay. I make this money. I spend on the house. This is the food, $20,000. I don't even think somebody will spend $20,000 on the food, grocery. But you have $30,000 left. You put in the bank account. What does it give you as an interest? 0.05, right? And you pay taxes on it because it's not tax free. What about somebody help you to make this money tax free? Because you're not using it anyway. Why do you want to pay taxes on it? Right? Somebody help you to put this money somewhere. Why is still your money growing more than this percentage and give you tax free? If your average tax is only 15%, I don't know how it's going to be 16% of average taxes if your income is $7,000, but I'll give you 15%. 30,000 times 15%. This is 4,500 in taxes that you are paying because you didn't make this money tax free. This is not even within the scope of our topic because I explained on maybe the last two webinars how to make your money tax free. I explained on that. So basically, over here, you are, because you did nothing, you are paying money on, you are putting money in your bank account because you want to maybe purchase a house, or I don't know what you want to do with the money, you want to invest the money, but you are paying $400,000 on it, $4,500 on it. So there are so many things. What about you making $500? $200 a year or $150 a year? What did you do? Did you do it because you hear people say, okay, you know what, you can do this, do that, or did you do it because you consult with the tax planning and you lay down everything that you think that you want to do with it? No. Most of the time you will be home, basically, because you didn't consult. And no tax professional will give you those advice for free because that is why they make money. They don't make money by filing $500 taxes or $200 taxes. They don't even do that. They will send you to other people. They will do tax resolution. People who have tax problem, they will charge them $10,000 to help them avoid paying $50,000 to the IRS. That's what they will make money. They will not make money whenever you think a tax professional is making money because he's doing tax preparation. You won't, because they make money because they help you saving money. They don't make money by just filing your taxes. By the way, okay. So yeah, that was just what I want to explain. And now I was about to show a small case study. A small case study, but if somebody has another question, you can just throw it out as I'm cleaning the board. Okay, now I'm taking a situation. I'm taking a situation of somebody that happened. That was a self-employed individual. I mean, somebody that I advised to actually create a business, because I think one of the past meeting or webinar, I explained how it's always favorable to create a business when you are doing something. I mean, instead of doing business as just self-employed people or sole proprietorship, it's better to incorporate your business because there are so many layers of security when you incorporate your business. And also, there are more deductions that you can take, right? There are more deductions you can take. If you're just a self-employed person, you cannot take, for example, put yourself into salary, which is what I said last time. A lot of people doing Uber or holding restaurant or holding hair braiding salon, they never even thought about themselves as an employee, even though they work on their business every year. And I showed them how much they were losing by doing that. Because you are working in your business as an employee, the profit, net income of your business is not your compensation. I'll just show you what is the compensation. There are so many structures that you can take, but you have to incorporate your business. If your business is incorporated as an LLC, a minimum, then you can actually put yourself as employees and pay yourself. That means you will write a check from the business to you. You didn't spend money to nobody, but it's an expense, right? So when you do that, now you're taking expenses, right? That's good. Now I'm going to show one of those self-employed, it was LLC owner. She has $100,000. She has $100,000. That was a tax planning. $100,000 gross sales, right? On a business that she's doing, she has $100,000. So $100,000 here. She was an LLC, right? Let's see the implication, tax implication, the expense, by the way. The expense was she was able to put herself $30,000 as her salary. That's correct. That means she cut a check every 2 weeks to herself, $30,000. The other expense was $25,000 here, right? This is the total of what? $55,000. That means she has $95,000 right here. So this is basically what will be called as a profit margin or profit. Because this is basically what people will call profit, right? Yeah, because it's a net income. That's what people will call net income. Net income here. Now, as a business owner, out of your net income, you have to pay what is called self-employment activity, self-employment taxes. As a business, okay, conducting a business as a business owner, you pay what is called self-employment activity, self-employment taxes. Self-employment taxes is now a 15.3%. You will pay that 15.3%. You have to pay that because you are your own business, you are the business owner, you are also your employees. You pay for the employees, you pay for yourself. When you guys are working, you pay half. Your boss, your company pays the other half. But if you are your employee, you're also your boss, you pay the whole 15%. So it's around 14,000. 535. So this is what he paid as self-employment. So I'm trying to compare. The project is to see how converting, whether converting the business for tax purpose from LLC to C Corp, to see if it will be available, to find out what will be more favorable to them, giving the same data, right? Over here, there's the same $150,000 here. This is the gross sales, right? Nothing changes. This is his own compensation right here. So over here, you have the same $95,000. But as a C Corp, there's no so-called self-employment taxes because the company doesn't belong to somebody. The company belongs to a lot of people. So if they don't have self-employment, you see self-employment. That means somebody is employing himself because you are the only owner of your LLC. You are subject to self-employment activity over here. So over here, but the company has what is called corporate tax. The corporate tax that's not only the only tax. I'm trying to come down with the tax that the company will pay. The company will also pay. There's also what is called Social Security. and Medicaid, right? Social Security and Medicaid is how much? 7.65%. But you have to pay this because you pay this when you pay yourself. This is a payroll tax basically. You have to pay this amount. So if you take 7.65% of 30,000, you get something close to 22.95. You pay because over here you're also employee, but here, so you pay Social Security. These two are taxes, right? These two are taxes. Now, what happened? What happened is that your gross income over here. What is your gross income? Your gross income, whenever you have a business, is all your income, whatever source derived. That means whether the income is coming from your work or it's coming from your own business or it's coming from different business, you have to combine all of them. The government calls it gross income. Okay, your gross income is what? Is this $30,000 here plus this net income. So your gross income is actually 125,000 because you are going to put this amount in your gross. That's your gross here. Same thing over here. You get the $30,000, but you also get the profit. That's your gross income. Okay? So you have 125. So what happens here when you do that? When you do this, the government will give you, by the way, I didn't account for the corporate tax. There's a corporate tax involved here. Corporate tax. The corporate tax is 21%. 21% of your profit. This is the profit here. So 21% of this profit here at the corporate level is 19,000. It's 19,950. So over here, it doesn't exist on the LLC level, right? Tax-wise, on this side, you are paying 14,000 here. You are paying Social Security taxes here. Over here, you are paying corporate tax here, and you are also paying Social Security tax here, but you don't pay the self-employment taxes. Okay, what is your gross income? Because now we have to go into your individual taxes and see what is your income taxes. Your income tax, we just said the gross income. The income tax goes from the gross income. We say gross income is your $30,000 plus your profit. That is 125. So you want 125 here. So what do you do? The government comes here and give you credit because as a self-employment tax here, the government give you credit for the self-employment taxes. They give you half credit of half of this one. So you have self-employment tax credit. So they give you half because everybody has to pay only half. Okay? You as an employee, he pays 2, but you get the credit for half. Okay. So that half is a 7,267.5. Over here it doesn't exist, right? Doesn't exist. So this AGI is adjusted gross income. You have to deduct this credit from this amount before we calculate these taxes. Okay? This AGI, we call it adjusted gross income. When you do the difference, it gives you 117, 732. 732. Over here, it doesn't exist. That means he has the same 125 as adjusted gross income. Now, what happened? You have to figure out the taxes, the income tax. the income tax for this level of income, and also figure out the income tax for this level of income. So when you use the tax table to find out the income tax, before the income tax, the government always give what is called standard deduction. Which is basically $12,000 for everybody. Everybody takes $12,000 standard deduction, right? It used to be that you can also take what is called an exemption, personal exemption, but the new tax law actually removed that provision, okay? So what you have now is a taxable income now. Taxable income. The taxable income, you take 12,000 out of this, you have something like 105, right? 105,732. And over here, you have 113,000. 113,000 here. Yes, this is the tax table right here. So on this is the taxable income. This is the real taxable income here. So from the table, your taxable income will be basically, we use the table. I have the table here. When you plug this level of income in the table, it gives you 19,665. This is basically what it gives. So his tax was 19,665. On the other side is 24,289.5. Okay. So over here, this is the income tax. Okay. That's the income tax that this person is paying here. Now, what we're going to figure out, what are the total taxes of this guy paying? The total taxes is not only this one, because remember, he was also paying self-employment taxes. He's paying half of this one because they give you credit of half. So he's paying self-employment taxes on this. He's also paying social security taxes. So we have to add both of them right here and put it here. That is other taxes that he's paying. Other taxes. When you add this amount with the self-employment portion, that is not a credit, because half of this is a credit, half is not a credit. So he's still supporting half of this self-employment taxes. So when you add up, it's 9,562. 9,562. So the total taxes for this guy here is what? It's basically 29,227. 29,227. Okay. I'm taking off all the decimal part. So he has 29,227. On this other side, this person is paying what? This is the taxes, income tax for the level of 1 territory. This is 24,000. By the way, he belongs to 24 taxes, 24% tax bracket. Same thing as this one. Those two are 24% tax bracket. They belong to 24%. Same thing for this one, 24%. That's the reason why the tax is actually 19,000, right? And now this one, on the corporate side, he pays income tax, but he also has other taxes. But the other taxes is only the social security. He doesn't have the self-employment taxes here. So he only has here 2,000, this amount, 295. So the total taxes is just to add the 24,000 to the 2,000. It gives us 26,584. 26,584.5. So when you look at these two situations, look over here. Over here on the LLC side, this guy, or it was a lady, she will be paying $29,000, $29,227. Over here, she will be paying $26,584. You see that just by comparing, we didn't change nothing. We just anticipated that she will make the same level of income with the same level of expenses, and we offer her something that if she does exact same, if the company just goes the way it went in 2018, if it does the same 2019, this is what it will be, right? Over here, you compare C code. Some people are afraid of using the C code. You will never know until you actually plug everything into perspective to analyze side by side. And there are so many entity structures. You have what is called sole powership, right? You have sole powership when you don't even incorporate. You don't even have LLC, just you and stuff. Over here it's an LLC. At least you have a limited liability, right? Over here is a C corp. You also have an S corp, right? There are so many implications, but I'm comparing these two entity structure. You see the difference here. The difference here is $2,643. $2,643. This is what she will be saving, right? This is what she will be saving here. This is what she will be saving. But do you really think the money she pays, it was only to be able to save this amount? No, because she invests the money. So when we got to this point, we actually went beyond what we actually anticipated. Why? Because this is the only entity that gives you that opportunity of not paying taxes. Basically, this is the only structure that gives you the opportunity of not paying taxes. How? I'm going to show you right now, because the profit was not to help to make her saving 2,000, because she might pay 2,500. If you pay 2,500, you're saving 2,600. You're not making money. There's no profit. You are in business to make money. So this is what we think out. We know that the C corp, you only pay taxes if you distributed the money, right? You only pay these taxes, the corporate taxes. Remember, guys, this is the corporate tax right here. You only pay corporate tax if you distributed this money here. But distributed the money to who? To yourself, right? So what about the tell you that just say that you didn't distribute the money and you don't pay these taxes, right? So I want you to say, you know what? Over here, it doesn't matter whether you say distribute or not, you have to pay tax on it. Escort, same thing. But over here, if you don't distribute the money, you don't pay this money here. This doesn't exist. What does that mean? It means that your real taxes, your real taxable income, right here, remember, taxable income. This taxable income, or your gross, your gross income over here, This gross income was made up of what? This one was made up of $19,000 and $30,000, because they assume that the profit is distributed. But if this profit is not distributed, the gross income for this guy making $100,000 a year, it was a lady, by the way, is only $30,000. That's your taxable income right here, which is basically her salary, right? Because she said that she didn't distribute the money. That's your salary right here. So over here, you also take, I'm going to bring it back here. I'll put it on this area here, $30,000 to align them. She's still taking the standard deduction, right? So the taxable income is $18,000. Taxable income, $18,000, as opposed to taxable income right here, same entity structure, $113,000. I want you guys to see. So the taxes here, first of all, she moved from the 24% to a 12% tax bracket. And what is your taxes? When you look at the tax table, her taxes over there is what? It's basically 1,969. 1,969.5. This is your taxes here. Can you imagine? So to these taxes, the only thing she will add as a total taxes is what? I'm going to remove this amount here. I'm going to remove this and put this here so we can see the difference. The difference was 2,643. Just the difference between these two taxes. I'm going to remove this one here. Okay? So over here, the only thing that he has to pay on top of this is the self-employment, right? The self-employment is still there. On her income, she pays self-employment on it, self-employment taxes on it. So on her income, she will also pay 2,295. So the total taxes is only 4,264. 4,264.5. So 4,264. Now you can see the difference. You can now compare this amount of taxes that she will be paying with what? With this amount that she would have paid if she was still on the LLC. For tax structure, it doesn't mean that your company become a C corp or your company become an S corp. It's just for tax. It's just an election for taxes. So the real difference, the real tax saving is what? Is 29,000 minus 29,227 minus 4,264. Right? How much is that? I found that to be 17,898. 17,898. So this is actually the real saving. This is the real saving now that she's able to get. 17,898. This is what she will get, right? This is what she got. Of course, she will get even more. By the way, you just focus on one factor here. So the saving here is 17,000. Can you imagine how much you are able to invest to save 17,000 by doing nothing but what you normally do in your company, that pay yourself, pay your bills, but just because somebody, a professional, has analyzed your financial structure, your entity structure, and told you that, oh, if you do that, this is what you can save. And you have done it, and this is what you save. So, yes. And that's the reason why they will ask how much it costs. It costs a lot of money. It costs a lot of money to be able to do those tax planning. That's the reason why so many people will not do it. That's the reason why so many people will keep overpaying taxes every year. Paying taxes doesn't mean you prevent yourself from doing what you normally do. You just do what you normally do. But you can structure your income or the way you even save your money, the way that is tax advantage to you. So that's basically what tax planning is. This doesn't happen at the end of the year. It doesn't happen at the end of the year. At the end of the year, we just see what is available. What we can take, we take it. What we cannot, the tax professional, if he likes you, you say, sorry, you didn't take this. You should have taken this. You should have been able to do this if you have done that. But if he doesn't, because sometimes when you let the person know, they want you to do something that is impossible, to start making stuff, false allegation you are taxing to make it happen. Some people will not even tell you because they want you to do the impossible to make that happen. And when you force them to do it, you are the one in trouble, because when the IRS will send you a letter they will not send your CPA letter. The CPA will always say that he has done what you asked him to do, and he showed him all the evidence for him to do it. It doesn't matter if you make up those evidence or no. So yes, if you have a question, you can ask a question before I conclude. Any question or observation? Okay, so if there's no question, it means that is good. It means everything is doing well. So okay, this is the end. This is the end of today's meeting, right? I'm going to stop the live, the Facebook live, and continue this with the Zoom meeting because I have stuff to share in the Zoom meeting group. The Zoom meeting is basically the group. I said at the beginning that I help those small business owners who are able to get the SBA loan, but some people are having some issue at this time to get access to the loan. I don't think everybody on Facebook should know about that. Okay, so yes, we have done, and you have seen everything here, but what I have shown here is just a tip of an iceberg. I want to tell you, because this is not even the only opportunity the person was able to take. This is one structure. When you do a tax planning, you show the person, if you do this, you save on this. You do this other one, the same year, you will save on this. You do this other thing, you save on this. That means, and I just show you on Amazon. Amazon it didn't do only one thing. He optimized on so many stuff. And that is how you come up with a big tax saving, right? It costs a lot. It will cost people from $1,000 to $20,000 to do a tax planning. And some people will know that it's a good investment, right? Some people will know. So yes, in order to help you guys, right, is that I have this program that I have designed specifically to show any business owner or individual taxpayer how to conduct their own tax planning and how to implement it without the need of a CPA. Okay, I have this program that can actually help you to basically figure out or do what we will do. Actually, it's designed normally for other accountants. Not all the accountants or tax preparers even know how to do tax planning. So that program is basically designed actually for them. But my goal is actually to help business owner, mostly small business owner, because it doesn't matter how you put it. People are used to spend $10,000 or $20,000 on tax planning. They will still spend the $20,000 on tax planning. But a lot of people don't have that money, or they don't know how to budgetize that money. That's the reason why we implement that program, that short course program, to actually help self-employed people, individual people, and business owners to be able to actually be in the position of a tax professional and do this for their own business, right? Maybe if they have some type of issue to implement it, by the way, the program will actually tell you how to implement it. That means if you really have an issue to implement it, you can consult somebody to say, okay, I want to do this because you already know what you need. This is in case you don't even implement. Although this program will show you how to implement, how to, for example, see all the structure of your business entity, and see this is only two. We have so many business entities. We can actually be able to see, to classify all the business entity and see all the results. And we even have tools for that. So I have that program that we have really been working on for years to be able to help that, to help business owners basically, because those are the people struggling the most. The business, I always tell people, if you're making $100,000 a year and you don't spend, people still coming when even though the meeting is over. So you don't spend even half of it. You should even actually create a business. Of course, I guess I'm still on the Facebook page. I thought I was starting to my cook. Okay, yes. So I have this program. So if you feel like you want to design and implement your tax planning by yourself, and you don't want to pay thousands of dollars to a CPA or tax professional, right? If you feel like you want to do that, the only thing I will ask is to show your interest by typing tax planning on the comment section of this video, whether it's on the actual webinar or it's on Facebook or on YouTube. You tax planning. I will manage to show you how to actually get in contact with it, right? You put in the content, I will actually send you the course that you could use for yourself, right? For yourself, for your individual situation, or for your business, or even to apply to help other individual or businesses owner to save taxes. And you can do it because those are friends to you, or you even want to make business to them. You want to make business by doing that. Okay? So you don't cheat that. I want to tell you something. We don't cheat everything that we do. Everybody does. Everybody goes to college. You don't cheat in college. You don't see nowhere when they teach you side by side everything. It's within the practice and the research that you learn all of this. That's the reason why I'm saying if somebody is interested, hit tax planning now. And it'll be my pleasure to actually send them, show them how to access those material to actually not only solve their own problem or their business problem, but also be able to do it for other people. I will give all the tools that we actually use. Okay, because I know a lot of people are in the need, but they just don't have the money, the investment for it. Even though I say it's an investment, they see it as an expense. An expense is something that you spend. There's nothing that you work in return. An investment is something that you spend because you know that by spending that you will make me receive this amount of money, or make me save this amount of money. Okay, in fact, if you have that, you can like become a tax planning specialist if you have that. Okay, so I'm done at this point. I don't know if you guys have a question. I'm going to thank everybody.